All right, there we go. Hey, hey, hey. Welcome, everybody. Let me make sure that everybody is muted. Let me get everything set up the right way. Gang, gang. What's up, my friends? Welcome back, everybody. Hope everybody is doing well. We'll wait a minute or two before we get started. I've got a fresh LaCroix. I've got a song very much stuck in my head. That Hags line, man. I was just telling Callan, it's just stuck in my brain. But hope everybody is doing well. Again, we'll give a few minutes before we get started. How's everybody doing? How's your trading day? How was your yesterday and today trading day? Today was kind of crazy. Big Kid Summer equals Hags. Facts, dude. Hags, man. We were riding those scooters the other day, and I gotta say, I genuinely believe that if anybody is like going through a tough mental time in life, that those scooters on that beachway will change your freaking life. I'll say that. All righty, so let's see here. There was 2 links. Everybody seems to be doing good. All righty, so let's get started, my friends. We have a thick bunch of slides to cover tonight. I want to make sure that we cover a whole lot of bases in terms of instruments that we trade, right? So again, in this lesson, we are going to be continuing on with our thought process on what are the instruments that we trade. How is it that we find what we're going to choose to trade that day from a strike selection? Is there a different strategy that we could possibly choose? Is there a more long-term based strategy that we use for building a long-term account, which we are going to talk about in tonight's lesson? And we are also going to talk about futures, what they are, how you can potentially get funded with a futures account that has up to you can potentially get funded up to 300K with a futures account. It's wild. There's a lot of potential out there in the funding world, so to speak. Also a lot of potential to go on tilt with these companies, these funding, these what are they called? Prop firms. There's also a lot of potential to go on tilt with them. So tonight we're going to talk about how to sort of get introduced into that niche, and then how to not treat it a little bit like a video game, right? Because it can definitely be fun to get funded with external capital, but it can also be very, if you don't do it the right way, you can end up spending a lot on these accounts, right? So first, tonight's agenda, what we have to do is we are going to cover the variety of option strategies that we did not cover in our last lesson, right? So in our last lesson, we started to talk about specific option strategies after having talked about how options work as a whole. So we talked about long calls, long puts, short calls, right? And tonight we're going to dive into short puts, straddles, strangles. We're going to talk about covered calls. We're going to talk about debit spreads and credit spreads. And we have some awesome experts on tonight to help answer questions. If I'm not mistaken, we have Mr. JBab and Mr. Mullet on tonight. Woo! We have JBab, Mr. Mullet on. JBab is a futures expert. I know he has multiple funded accounts that he actually trades that are real money with. I know he's taken withdrawals from those funded accounts. And then I know Mr. Mullet is our resident expert options seller in the room. So if you have any questions about futures or option selling, these are 2 people that can absolutely help answer your questions along the way. Right. So as a reminder, the format in which we are going to go through these lessons is we're going to talk about a particular strategy. Then we're going to ask a variety of questions about that strategy. Right. We're essentially going to clarify, is this strategy bullish, bearish, or neutral? Is this strategy a debit or a credit position? We're going to ask the question, does this require directional accuracy? We're going to ask, how do we calculate max risk and how do we calculate max profit on this trade strategy? And then in essence, are we going long, short, or is this a neutral trade on this particular position, right? So first, we talk about long call options, right? It's an inherently bullish strategy. It's a net debit. You pay to purchase these calls, right? They do require directional accuracy. Your max risk is simply the price you pay. You cannot lose more than the price you pay. Your max profit, in theory, is unlimited if the stock were to continue to go up and up to infinity. So in essence, when we want to go long on a stock, one way to do so is to buy call options, right? The option buyer has the right, but not the obligation to buy 100 shares per contract at that agreed upon strike price. The other big thing that we took away from last night's section was, how do we select a strike price, right? We went through an exact breakdown process of, okay, A, B, C, D. Here is how we choose the strike price that we are going to trade for that option. And the biggest takeaway from that slide is, again, where is the target, right? At the end of the day, we want our options to be able to be in the money so that we can calculate exactly how much they will for sure be worth excuse me. That way we can calculate exactly how much they'll for sure be worth and be able to calculate our risk reward accordingly, right? So then we talked about long put options. No need to go through these again in depth. However, it is the same thing as long call options, just on the flip side of the equation, right? Now, the reason that I have this slide here again is because in our next slide, I want to cover the flip side of this, right? So let's talk about this example just for knowledge purposes, right, so to speak. Long put options is an inherently bearish strategy, excuse me. As you all know, when you purchase puts, you're paying a premium in hopes that the stock price goes down typically, so that you can then sell that put at a higher price, right? Now, when you purchase that put, much like the call where we talked about the other night, there is somebody on the other side of that trade. The vast majority of the time, it is going to be a market maker. And we talked about how on call options, we never want to sell call options intentionally or unintentionally, because the potential losses on them can be up to unlimited, right? However, selling put options is actually a really viable strategy, right? So selling put options, again, let's imagine in this example, you're somebody who purchased a put on Apple because you think Apple is going down, right? I'm somebody who sold you that put on Apple because I think Apple will either stay flat or go up, right? There is somebody on the other side of that trade. So on my side of the trade, I actually have an inherently bullish strategy, right? I am receiving a net credit. When you purchased a put option for 1.0 or whatever the price was, I received that price that you paid. I received that premium. Right? Like we talked about with theta last night, it actually doesn't matter if the contract stays flat or goes up. If it stays flat, me as the option seller can potentially capitalize on theta and still make money, right? My max risk on this trade is if the shares were to go to zero, right? If the shares go to zero and I have a short put option, in theory, I would lose my entire investment, right? However, that's the same risk that any trade has if you are long shares, right? If it goes to zero, you still could lose all of your money, right? So inherently, trading short put options doesn't bring on more risk than just trading the shares themselves do, right? The additional benefit that you can have from these short put options is that you can receive that credit, right? When you pay 1.0 to purchase an Apple put, I receive the 1.0. That is mine. I get to keep that. If the options go to zero, whether they expire in the money, whatever the case may be, I get to keep that 1.0, right? So in essence, when we want to go long on a stock, one way to do so is actually to sell put options, right? So the difference between buying and selling put options is if you're a puts option seller, you are required to take the 100 shares of that stock at that strike price when that time comes, right? You don't have the choice, so to speak, like the buyer does. If you let it expire, you actually have to take the shares for sure. Right? So let's talk about an example of this, right? Let's talk about when to use short puts as a strategy, right? The best time to use them is when IV is high or when during market pullbacks or market crashes, right? However, you can really use these anytime on a stock that you would like to own at a certain price, right? This example didn't age super well because Disney is now trading at like 88. However, let's talk about it, right? Let's say that Disney back in the day was trading at 140. Right? And you're comfortable holding Disney for the long term. You believe in them. You love the Disney parks for whatever reason. You're attracted to Mickey Mouse. I don't know. But you believe in Disney as a company and you think that Disney is going to work and you trust your investment. It's a long-term hold for you. You don't really care what happens on the short term. You're holding for the next 20 years, right? However, for some reason, whatever reason, you don't like it at 140. You want it at 130. You wouldn't mind. You don't mind it at 140, but you'd prefer it a little bit lower in price. Whatever reason, valuation, math, fundamentals, I don't know, yada, yada. You decided you like it at 130, right? Instead of simply setting and limit order buy at 130, which you could do, and in theory, you could just wait for the shares to reach 130, and then eventually your limit order would get filled, and you would own Disney at $130 per share. The other option that you could do is sell the 130 strike puts, right? So let's say in this example, you sold the 130 strike puts for $2, 2.0, right? Meaning that whoever bought that put off, you paid 2.0 for it, right? And you got that $200 that they paid. You get to keep that. That's yours. It's yours no matter what. Nobody can take that away from you. Ever. Never, ever. Right? You always get to keep that credit unless you choose to close the position. Right? So the way it would work is that you would be selling to open one Disney 130 put at 2.0. Right? So again, even if you think the person above you is right, I know this is a little bit of a slower lesson based on the last ones. Again, like I talked about in the last one, it's very intentional. Give me an answer here in the chat. What happens to those Disney 130 puts? Just what happens to them if Disney closes the week at like 133? If on Friday we close at 133, what happens to those puts? Anybody have any ideas? Expire, worthless. Exactly. They're out of the money. They're worthless. They have no intrinsic value. Nothing happens, right? Like we talked about in the previous lesson, they have no intrinsic value. So at expiration, they have no intrinsic or extrinsic value because there's no time left. And so all of a sudden they are worthless, right? So if that were to happen, if Disney were to close above 130, if you had just set a buy limit order at 130, you would not have gotten filled, or let's say it never traded down. You would not have gotten filled, right? However, if Disney closes at 132, right, the 130 strike put trader, the person who sold those, gets to keep that $2 credit, aka $200, right? They get to keep that credit, and they still just get that's theirs. Then they move on to the next trade. So as opposed to their order never being filled, they get to keep an additional $200 on that individual given trade, right? So if Disney were to close under 130, that's where it starts to become a little bit of a different trade, right? So if you sell the 130 strike puts, and if Disney closes below 130 upon expiration, you would then be assigned those shares, right? Meaning that you would have taken in those shares and you would own them now. So let's say that Disney closes at 129, right? Based on the option strike price that you sold, the 130 strike, remember, you agreed, like we talked about, you agreed to buy 100 shares at that strike price no matter what, right? So you technically do receive the Disney shares at $130 per share, right? Based on everything we talked about before. However, you also receive that $2 credit. And like we talked about, that's yours. Nobody can never, ever take that away from you unless you chose to close the position, right? So in reality, while you actually got your Disney fill at $130 per share, your realized cost basis is $128, right? In reality, you actually own Disney at $128 because you received that $200, which is equivalent to $2 per share on 100 shares, right? So in theory, if you were to do this month over month consistently over time, let's say you do this for 6 months, and each month you sell one put option that's worth $200. Over the course of 6 months, you're going to make $12, aka $1,200 off those trades, right? So next thing you know, when you buy 100 shares of Disney, whatever price you buy it at, eventually, or whatever price your options get filled at, eventually, right, you will have essentially owned them at a discount, right? So you will have gotten the shares at a discounted rate. It's essentially being able to like pick your entry price, right? So selling a short put option allows you to literally pick your own entry price. The only caveat to this is that you have to be comfortable owning the stock price at that price, which if you are going to buy it for the long term anyways, that means that you were comfortable owning it at that price anyways, right? So there's no disadvantage or added risk to short put options relative to just trading long-term shares. It actually gives you a lot more flexibility in what you do, right? So if you were to go through with this particular trade, right, you would have received 100 shares of Disney at an average cost basis of $128 per share, which would be $12,800, right? Not a cheap investment. I'm aware, Jake, I'm taking your mastermind course. I don't have that much money. I'm trying to make more money. That's the whole point of me taking this course. How the fuck does this apply to me? Well, multiple things, my friends, multiple answers to that question. First of all, you all are in this program, right? My expectation isn't that you become rich overnight, but with the course of work and dedication and hard work over the course of the next 6 months, year, I expect you to not only be consistently profitable, but making good money, right? It might take different amount of times for everybody, but you are going to have capital at some point is the expectation that you want to invest in other facets. I've talked about withdrawals all the time. What do you think I do with the money that I withdraw? It goes into long-term investments, right? It rotates into long-term accounts that is more safe, right? It's more protected, right? So you may not have the cash that you want right now for long-term investments. The assumption is that you will be getting there after the completion of this course, right? That being said, you also don't need to choose expensive stocks. There are a bunch of stocks out there that are much more viable to do this at a lower price, right? The one that we always gravitate to, mainly because Jordan, Mr. Mullet Man, answering in the chat, is an expert at this one, is SoFi. SoFi, last time I checked, it was trading in like $6 to $7 to $8 range, something like that, right? So 100 shares of SoFi would be $600 or $700 long-term investment. That's not that shouldn't seem outlandish for anybody in this room. If you purchased a $2,000 course, I don't think a $600 long-term investment should be something that you're like gawking at. That's like, oh my God, that's unrealistic, right? Like, especially not with the assumption that you're going to be making money in the near future, right? So this is a strategy that not only do I think you should keep in your back pocket for once you raise your capital, there's also plenty of you out here who take this program who have capital that you're ready to use, especially in a long-term account with a more safe and risk-averse strategy. This is one of them. This is probably the best one out there, right? I have friends of mine who literally what they do is they start each like year or month or whatever the time block is with like $100,000, and they will use a short put strategy to try and generate like 1% to 2% a week. And obviously there's going to be some weeks where you're red. It's the way trading works, you know that, but it's like a proven consistent strategy. It's called the wheel out there, right? I have a friend, Max Options Trading, Big Daddy Max. This is literally how Max makes a living. I know Max well, and I know Max, and this is literally where he makes his living, right? So this is the type of strategy that, especially for those of you who have more capital, this is one that you can start to implement like right away. And even any of you who are like, I don't have that much capital yet, there are smaller, less expensive names out there that you could still run this strategy on, and you could start to be building a long-term investment account, right? I know that Jordan himself was running this strategy on UPST, Upstart, back when it was trading in like the $15 to $20 range. And he actually has like a reel about this on his page. So in theory, if you were to be running that wheel on this entire time, you would have been participating in this move up where UPST has gone from like 15 to 60 or whatever the number is, which is a crazy run up and crazy rally, right? Back. And if you participated in UPST, that would have required about $1,500 of capital for each long put that or short put that you sold, right? That's not like a crazy outlandish number for you all to be long-term investing, right? So this strategy, it may seem like it's like, Jake, I don't have the cash for it. One, I expect you to get there. Two, you probably do. It's not as far out of the reach as you might think it is, right? There are a ton of names that you can do this on. And again, it can be, especially if you have more capital. If you have more capital, I genuinely believe that you should probably book a one-on-one lesson with like with Mullet, with Jordan or Joel, somebody who has experience with short puts and selling options and covered calls, because it really can be a way to utilize like a long-term portfolio. I know it's not everybody in this class, but believe me, there are also plenty of whales in here who are, 50K account plus types of traders. This is a very good strategy to use for you all, seriously. So in addition to that, right, let's talk about another example of that here, right? Or another portion of this strategy that you can kind of extrapolate and add on to the short puts, right? So we talked about short puts. There's another side of this that is known as covered calls. We talked about how we never want to sell naked call options. That's just not what we do, right? We talked about that in earlier slides. We don't want to sell short call options. We don't like that the risk reward that it provides. We don't like the fact that we could potentially lose unlimited to the upside. We're cool with it, right? However, if you own 100 shares of that individual given stock, right, then you can sell call options against it, knowing that you're protected. You don't have unlimited losses, because worst case, you can exchange those shares, so to speak, and just lose the shares. So by owning shares, you are effectively covering, the name, covering the call contracts that you are selling, right? So in essence, one thing that you can do is you can start to create your own dividend on shares that you own. So if you own a long-term shares position, I would highly, highly recommend that you look into selling covered calls against it, because it's a way that you can start to generate cash flow on a long-term position, right? You can use options to do that. So let's say, for example, that you buy 100 shares of AMD at $120 per share, right? You then take that trade and you add a leg onto it by selling one 125 call option at 1.0, aka for $100 right there, right? If you were to take your average price, the 120 that you purchased at, and subtract the $1 that you received when you sold that 125 call, it would leave you with $119 as your realized cost basis, right? Pause. Which takes us into our next slide, where I want to break down the format of this covered calls, right? So again, inherently, these are a bullish strategy, right? However, they do not necessarily require directional accuracy. If the stock stays flat, you can benefit from the stock staying flat. Your shares don't lose any value if the stock stays flat, but the options you sold will, right? So they do not require directional accuracy. The max risk that you have on this trade is the price that you pay. So including the shares going to zero, right? That's pretty much the max risk. Max profit, we're going to calculate in the next slide. But in essence, when we want to go long on a stock, one way to do so is to use covered calls, right? You're essentially buying 100 shares and selling one call contract against those 100 shares, right? The one downside of a covered call is that you can cap the amount of profit that you could make on that trade, right? So let's say you buy 100 shares of AMD at $120 per share, costs you $12,000 to do that, right? If you sell a 125 call for 1.0, that reduces your cost basis down to 119, aka 11,019. Oh, why did that skip ahead so much? Did that just delete my slide? Why did it delete my slide? There we go. There we go. Equals 900. Right. So in order to calculate max profit, you would take your strike price and subtract your realized cost basis. So your strike price here is 125. Your realized cost basis is 119. That leaves you with a maximum profit of 6.0, aka $600. Right. So that's the downside to a covered call position. Right. In theory, you could have bought an AMD at an amazing price at 120. And if you sold a covered call for 125, it doesn't matter if AMD opens up the next day at 300 because of some crazy news or buyout or something like that. You do have a maximum profit on this trade. So that's the one downside. That's the one downside of using a covered call position, right? Is that ultimately you can kind of cap your upside a little bit, right? A little bit. You could have the potential to lose your shares, so to speak, right? That being said, right? That being said, right? Let's run through an example here. You buy 100 shares of AMD at 120. You sell one 125 call for 1.0, right? AMD goes to 127. And like we talked about, because you sold that 125 call, you do not get a choice in this. Your shares get called away at 125. You lose them. They are gone, right? So let's say you lose your shares. They get taken away at 125, but excuse me, but you still really love AMD for the long term. You still really want to be invested in AMD for the long term. What is one option that you could use to reinvest yourself and get back into an AMD position? What's one system? And give me an answer to this one. Fill up the chat a little bit again, even if you think the person above you is right. No, it's not the most exciting lesson, but what's one thing that you could do? Short puts. Exactly. This is not trying to reinvent the wheel here, quite literally, right? You could then sell a put option. So that's where the term the wheel comes from, right? Is that it's literally a wheel system, right? So in theory, what traders will do is over and over again, they will use a shares position, right? They will sell covered calls against it. Once those shares get taken away, right, they will then start to sell puts and start to build up a credit, right? And it really builds this like crazy, the wheel is the best way to describe it, but it really builds this like crazy powerful system, right? Where you can ultimately kind of be generating returns on your capital in a very quick manner, right? Like it's slow compared to what we do in terms of like day trading, in terms of like making 50% on one trade. It feels slower. If you compared the percentage returns on a short put covered call account versus, you know, just generic holding, it's going to be significantly higher if you're able to capitalize well, especially if you have knowledge in the technical field. So you'd have advantage of knowing when to sell puts using the chart, right? So it really is like a very powerful strategy, right? And it is something that I don't want it to get glossed over. And it is something that I don't do it on an active day-to-day basis anymore, just because the way my brain works is that I can't juggle too many things. And with now the business and the mastermind and my own trading and day trading and swing trading, and then my own long-term investments and then real estate and all this shit, it's hard for my brain to do this on a weekly basis and still function. Truth be told, I should probably like hire someone to be running this on my long-term account. But for this is something that it was like a revelation, and especially during the COVID crash. My dad and I did this on JP Morgan and Disney and a few other stocks and got some crazy entries. I remember posting some alerts like way back in the day in 2020 being like, I just sold puts on JPM, and everyone was like, what the hell are you talking about? And I was like, you don't know shit. But I got JPM at like 70, right? Or something like crazy like that, right? So again, during times of a market pullback or on any stock that you're comfortable owning for the long term, this is a viable strategy, right? And again, while it may not seem viable to those of you with less capital right now, it is absolutely something that you should be planning to do in the near future, and also something that you should be considering as more realistic. I think max options trading, my friend who does this full time, is with the wheel, is like what he does. I think his favorite stock to do it on is Labu, which I have qualms with because it's like a decaying asset, but nonetheless, that's a $4 ETF, right? Like it really is. If you're taking advantage of the premium, right, then you can capitalize on it regardless of the stock itself, right? That's really the benefit of using the system as a whole. So even if it's not something that's super applicable to you now, it is something that I love to cover, because I would say that if you want to be a successful day trader, a big portion of that, and I think that this element of it is like not really talked about enough, but a big portion of being a successful day trader is being good with like your money and rotating your money out of some things that you are doing and into other things, right? And having your money, we've talked about this explicitly in lesson 2. In my opinion, having your money like locked up in a day trading account where you are trading constantly is not a good thing, right? So you have to start to get, not only do you have to start to consider this as a realistic option for you all, but I literally want you to start getting in the mindset. Part of the reason why we take withdrawals is not only to protect our capital, but it's also to put you in the mindset of a full-time trader, right? Like a full-time professional, consistent trader withdraws their profits and keeps them safe and like uses them on life, right? So you ultimately want to start to be training your brain to do the same thing. So let's say 1 week you have an excellent week, right? All of a sudden you've made $1,300, right? And you want to withdraw that capital and you want to ultimately keep it safe. One thing you could do is take that $1,300, put it in Robinhood, and start running the wheel system on SoFi, right? And you'll be doing one contract, probably only be making $3 to $10 on an individual contract, right? Maybe even less than that, but you'll own 100 shares and you'll start to be going through the mental process of what it's like to be a consistent day trader who does this stuff, right? Like this is what you do, right? Like you make your money trading and then you take it out and you do other things with it to help it grow. This is one of the big things that you do, right? So I don't want this to be like glossed over as like something's like, oh, we talked about covered calls in the wheel strategy. It's like, no, this is something we've talked about. Now it's time for all of you to like take action on it, right? Because I truly, truly believe no matter the account size you're using, this is something that can benefit your trading as a whole, right? So next up in our presentation, we are going to be moving on to the spread section. And I love talking about the spread section because this is very, very applicable to small accounts. So we just talked about covered calls in the wheels, and I did do a heavy emphasis on why they are also applicable to small accounts or smaller accounts, but they're definitely geared towards people with larger capital and names that you like to long-term invest in, right? Like an Apple or something like that, right? However, debit spreads and credit spreads can be catered to all account sizes and can massively help you manage your risk and participate in swing trades. That's really, I think, the best takeaway to use from a debit spread is, hey, now can I participate in a swing trade because of this, right? Like, does this allow my risk tolerance does this spread allow me to fit within my risk tolerance on this particular swing trade, right? So tonight we're going to talk about 4 different types of spreads. We're going to talk about debit spreads, and underneath that umbrella, we're going to be talking about call debit spreads and put debit spreads. Then we're going to be talking about credit spreads. And so underneath that umbrella, we're going to be talking about call credit spreads and put credit spreads. We're talking about what those are, how we trade them, when to use them, and how you choose your strikes on them, right? So first, we have to give a little bit of a definition here to what is a vertical spread, right? We're going to be referring to the term vertical spread a lot, so I want you to become familiar with it, right? So a vertical spread itself, if you just use that broad umbrella definition, a vertical spread involves the simultaneous buying and selling of options of the same type, aka buying and selling a put together or buying and selling a call together, of the same expiration, but at different strike prices. So the term vertical comes from the position of the strikes, like if you were looking at an options chain, right? So in this particular trade, a vertical debit spread, vertical debit spread, vertical debit spread, you are simultaneously buying an option and selling a further out of the money option. By doing that, you are left with a net position that is directional, meaning that you don't favor from neutral or flat movement. You do need the stock to move in your favor in order for you to be profitable, right? So these names are actually very simple. They'll get a little bit confusing in a couple of minutes, but they're simple now. For calls, this would be known as a bull call spread or a call debit spread. It's a bullish trade. It's a bull call spread, call debit spread, bullish move. To the downside, you would be purchasing a bear put spread or a put debit spread. This would be a bearish position, right, that you are hoping to capture to the downside, right? So vertical debit spreads. First, let's talk about calls. Vertical call debit spreads are an inherently bullish strategy. We just talked about that. There are a net debit. You pay a net debit in order to purchase these call spreads, right? So in order for you to enter this trade, you are going to pay a certain net debit price to enter it. They do require directional accuracy, right? So in order for you to make money on this trade, it has to be in your correct direction, right? Next up, the max risk on your trade is the net debit that you paid, aka you cannot lose more than what you paid for that price. The max profit that you have is the width of the spread minus your net debit. So we're going to do an example question in just a second, but let's all do some math here. And everybody wake up a wee bit with me. I know it's not the most exciting one, but wake up with me because I'm going to have a question and quiz for you in a second. I want you to answer it. So in order to calculate the max profit on a spread, you're going to take the width of the spread and subtract the net debit. We'll talk about that more in just a second. Right? So in essence, when we want to go long on a stock, one way that we can do so is to use vertical call debit spreads, right? Vertical call debit spreads, right? So let's run a profit formula here, a max profit formula. Let's say that you purchased, you're bullish on Apple. This is pre-split on Apple. You purchase an Apple 400, 410 call spread, right? Let's say you purchase these at $2.50, right? So then we take the formula that we just talked about, right? Which is width of the spread minus net debit, right? So you first take the width of your spread, $10 wide. You paid $2.50 for that contract. What is the maximum profit on this trade, my friends? Even if you think the person above you is right. Yep. You're all great with math. All right. I'm glad I asked because someone said 850, right? And do not feel bad if you got this wrong. This is the type of thing where you're going to get it wrong. You're going to realize that you're going to be like, ah, shit, I know exactly what I did. Or you might have just said 850 to be fucking with me. I don't know, right? However, it was 750, or excuse me, 750 max profit, right? So we had a $10 wide spread, right? Meaning the Apple 400, 410 calls, right? And they cost $250. So we took that 10, we subtracted the $250. They left you with a total of $750 of max profit. Now, your broker will always tell you this information if you know where to look on your order confirmation window, which it's very obvious. But it is important that you understand from a background perspective where that number comes from, because you want that to be a factor when you're determining your potential risk to reward on a spread, right? So on the put side of this trade, it's the exact same thing, just with puts, right? Puts, vertical debit put spreads are an inherently bearish strategy. There is a net debit that you pay to receive those spreads. They do require directional accuracy. The max risk that you have is the price that you pay. The max profit that you can make would be that same formula, width of the spread subtracted your net debit. So if you did an Apple 400, 405 put spread at 150, your max profit would then be 350. As you subtract that 150 from the 5.0. So in essence, when we want to go long on a stock, one way to do so is to use vertical debit put spreads, right? Vertical debit put spreads, right? So on the flip side of that, we have this other side of the trade. Like we've talked about with long puts and short puts, there's always another side of an options trade, right? Because options are an end game. There's always a buyer and seller. There's always somebody on the other side of this trade. Right? And the other side of that trade would be what's known as a vertical credit spread, right? So again, a vertical spread in general just involves the simultaneous buying and selling of an option of the same expiration. In a vertical credit spread, you are buying an option and selling a further in the money option. Your net position is directional, but you can benefit from neutral behavior, right? So on the call side of this strategy, the names get a little bit wonky here, like I mentioned, right? On the call side, it is a bear call spread or a call credit spread, aka bearish, right? So if Apple was trading at 400, you would sell the 405 calls, you would buy the 410 calls, and that would leave you with your net bearish position. You would have a 405, 410 call credit spread, a bear call spread, and it is a bearish position. Even though calls are typically bullish, this is a reference in which a strategy with calls would be bearish, right? And the same thing happens with puts. A bull put spread is what this title would be called for a credit spread. Right? A vertical credit spread using puts would be called a bull put spread or a put credit spread, right? So a call credit spread, if we were to look at these credit spreads, both call or puts, right? Mainly, let's talk about the specifics of a call one here. This is going to be an inherently bearish strategy, right? A bearish to neutral strategy. You are going to receive a net credit, right? Because when another trader purchases the debit spread that we talked about in the previous slide, that's what you are going to receive on the flip side of that trade, right? The nice part about credit spreads is that they do not require full directional accuracy. The max profit that you can receive on a vertical credit spread is the credit you receive. So if you receive 2.0 at the beginning of that trade, the max you can make on that trade is that 2.0 going worthless. You cannot make more than that 2.0, right? So in essence, when we want to go short on a stock, one way to do so is to use call credit spreads, right? So my general rule of thumb, and we're going to talk about this a lot more in just a few minutes, but my general rule of thumb is that credit spreads must aim to be 1-to-1 risk to reward. And I know that sounds wonky. It's like, Jake, don't we normally want at least 2-to-1? Yeah, I'm going to talk about that more in a little bit. Don't worry. But the bare minimum that I look for is at least aiming to be a 1-to-1. If it's slightly under 1-to-1, that's okay. But on credit spreads, I look for at least that area of 1-to-1, right? So let's take a look at an example here, right? In order to calculate your max risk on this trade, right, you would have an Apple 400, 420 call spread at 550. Right? So in order to calculate the max risk, you would take the width of your spread, which is $20. Then you would take your net credit, which is $55, $5, 5.50, right? And that would leave you with this formula, 20 minus 550. Now, filling in the blanks for you all, the answer to that one would leave you with 1450, right? So the max profit on this trade is the credit you receive. Like we talked about on this slide up here, the maximum profit that you can receive on a call credit spread is the credit that you get. Meaning on this trade, the max profit you could make is 550. And the max risk you could have is 1450. Yikes! Right? Yikes! This is not what we want. This is not what we aim for. A 1450 risk for 550 potential gain is nowhere near that 1-to-1 minimum that we try and aim for on a credit spread, right? So let's look at another example here. Let's say that you took the Apple 400, 420 call credit spread at 8.0. You sold that, right? It has a $20 wide spread. It's $8 credit that you received. That would leave you with what? A $12 potential risk. So in that trade, you'd be risking $12 to make $8. Based on everything I've taught you so far, I still don't expect any of you to be on board with that as a risk reward. But credit spreads are the one exception to risk reward, and we'll talk about why, like right now, right? So if you think about this, I want to just before we dive into the slide that breaks it down in detail, when you enter a stock, whether you're buying options, whether you're buying stock, whether you're buying futures, whatever, when you enter into a long position or a short position, whatever, generally speaking, there is how many different outcomes that could happen to you on that one? 2, right? You enter a stock, you buy calls, stock goes up or stock goes down. Stock goes up, you make money. Stock goes down or stays flat, you lose money, right? So if you're buying call options, right? If you're buying call options, right? I guess I should have said, excuse me. When we enter a trade, there are 3 options. Like goes up, goes down, goes sideways. If you're buying call options or you're buying put options, right? You only have one of those 3 in your favor. So in theory, you have 33% odds of success. Again, we're ignoring the chart. We're ignoring everything else. All we're looking at is just literally when you buy calls or you buy puts, there are one of 3 things that can happen. It can go up, it can go down, and go sideways. And if you buy calls, you would make money when it goes up, and you would lose money when it goes down or goes sideways, right? So you have a 33% chance in that sort of outlook, right? If you enter a credit spread, right, all of the sudden, you now have a probability edge on your side, right? With most of the credit spreads that you would be looking to take, right? Especially ones with poor R, you're definitely going to have a probability edge on your side, right? Because if the stock goes down, which in theory has a 33% chance of happening, if the stock goes sideways, which in theory has a 33% chance of happening, you still make money. So the reason that we are cool with lower risk to reward on credit spreads is because you have a higher probability of the trade working in your favor because there are more potential outcomes in which you can profit from, right? So if you're somebody who has a more intensive 9-to-5 work schedule, credit spreads are likely a very good potential outlet for you to trade because they are less actively managed, and on sideways movement, you can potentially profit from that, right? So I know it's not ideal when you see this, something like an 8 to 12, and truthfully, that's right on the border. Like, I don't know if I would take that personally. I would try and go another strike deeper in the money just to try and make it more of like a 1-to-1 or as close as I could get, right? But there are going to be times if you trade credit spreads where you favor the probability of your trade working a little bit more than the risk to reward that you have, right? So why at any point in time, Jake, this is fine and dandy, but you already taught me how to buy puts, my dude. If I know how to buy puts, why would I ever do this call credit spread bullshit, right? Well, let's talk about it. Why would you use that over a different position? Well, one, if you wanted to have more of a credit position, right, AKA more of a neutral position, this would be a good strategy. If you wanted to have time on your side, AKA you thought a move was going to happen, you just weren't really sure when, right? If you just really weren't sure when, then all of a sudden you have time and theta on your side. If implied volatility is very high, AKA let's say you were bullish on Google, right? Bullish on Google for their earnings report with high implied volatility, you could have taken advantage of that by selling put options, right? So the reality is it's a completely different trade from just buying a put, right? They are 2 completely different trades. And like I mentioned, I would probably say the most applicable way for those of you to use this, which is literally the reason why I spend time covering it, I wouldn't do this if I didn't think it was usable for you all, is for those of you that have more 9-to-5, very limited things where like you just can't watch screens that much. And on a regular basis, you find yourself just not even able to like check the market as much as you want to at all. Credit spreads are actually a really good potential outlet for you to trade because they're just less actively managed, right? They are 1,000% less actively managed than a buying options position, right? So now, why would you use a debit spread over just purchasing a put? We talked about on this slide here, this one's out of place. We talked about on this slide here, right, how a credit position would have these various benefits, right, of over just buying a regular option, right? What about a debit position, the one that we talked about earlier on? Let's give an example here. Let's say that you really want to short Tesla. You fucking hate Elon. You think that Tesla's bullshit. You think that I don't know. You don't like the guy. You just don't like his face and you want to short it. Okay. Option A is to buy Tesla 250 puts at 5.0, right? Those are actually pretty expensive, right? 5.0. Not everybody has an account size where swinging a $500 contract that is a weekly expiration option is within their risk tolerance, right? So another option that you could do is use a 250, 245 put spread at 2.0, right? Rather than just buying a more out of the money option that doesn't fit into our criteria of deltas that I gave you in our last lesson, then all of the sudden, right, it becomes much more appealing where, okay, I'm a small account. $500 overnight is a lot of risk for my trade. What if I can cut that by 60%? Okay, all of a sudden that becomes a much more appealing trade to many of you out there. So if you're someone who's been limited on swing trading because the risk of some of the contracts is simply too high, using a debit spread is a literal direct path to reducing that hiccup, right? The other thing that's really beneficial about spreads is that they are less subject to theta decay, right? So you are going to be, spreads as a whole are going to be less subject to a decay from theta because you're going to be profiting off some of the theta off the contract you sold. You don't have to worry about the minutia details of that, but the takeaway you should have is that you are less subject to theta decay overnight, typically speaking, than you would be compared to just buying the option itself, right? So for small accounts out there, this is a direct path that you can take to start swing trading with lower risk and potentially make some really high rewards, right? So on a debit spread, there are like a certain price range that I like to try and stick with it. So if we're taking a $5 wide spread, typically speaking, I like to be paying a debit of like 1.0 to 150, right? 150 is usually like the max. I don't usually like to go above that, right? Risking 150 to make 350, right? I'd be risking the entire position, presumably, right? Just in case overnight options, anything can go wrong. Risking that 150 ideally to make 350, right? So a $10 wide spread risking. So again, sorry, let me stop there. That risking 150 to make 350. Now you can then extrapolate those numbers as you get wider and wide spreads and just use the same proportions, right? So on $10 wide spreads, I would ideally like to be risking about 3 to make 7 max, right? I would prefer it a little bit lower, right? In a dream world, what you will find oftentimes on Thursdays, you can find high quality opportunities that are low capital risk for potential high reward swing trades into Friday, right? On the type of dream world scenarios where you get like an Apple $10 wide spread where you're risking 1.0 to make 10.0, right? Or you're risking 50 cents to make 450 on a more expensive options contract, right? AKA you're trying to make like 800%, right? Those are the ones where if they're actually the chart telling us that there's a viable trade in there, you can potentially find some really low capital risk positions that could give high returns, right? Without as much risk as a 0-day to expiration option, right? What I don't like in debit spreads is I don't like risking 2 to make 3. That just doesn't float my boat, mainly because dynamic R starts to shift in a negative way pretty early on in that equation, just from an options contract perspective, right? So I don't love risking 2 to make 3, right? So on a credit spread, as mentioned, my ideal risk reward is at least 1-to-1. So on a $5 wide spread, I want to be risking 250 to make 250 in a dream world, right? Why am I okay with that lower risk multiple? Because 66% of potential outcomes are in your favor, right? So I'm actually okay with some credit spreads as long as you have a really good chart reason behind it too, for you to risk 3 to make 2 on a credit spread because you have those potential outcomes in your favor, right? You also don't have to hold till 0. You can always stop out of that position early. What we don't like, however, is risking like 4 to make 1. The math just becomes too hard at that point. Even if you were to win 80 trades in a row, if you lose 5 in a row subsequent after that, you're going to take a big hit, right? So I do not like risking like 4-to-1, right? So, all right, with that, we're at the 5:50 mark. Let's take our pause, our pee break, take a water break. We'll be back and we'll probably be wrapping up in the next 20-ish minutes or so. All right. So everybody, pee, water, BRB. All right. BRB. here with our last discussion of option strategies. And really, we're going to move through these rather quickly. I said 15 minutes, but I actually think that it's going to be a little bit quicker just because straddles and strangles, truthfully, aren't something that I think are like super viable strategies. However, it's important to talk about because every class, there's a few people out there who are newer to options, who are learning straddles and strangles, and you think that they might be the end all be all. And I'm here to tell you that they're not, right? So a straddle is an option strategy involving both the purchase of a put and call for the same expiration date and the same strike price on the same stock, right? So essentially, you're buying both an at the money call and an at the money put. It's a neutral strategy. You pay a net debit. And in essence, when you expect a really big move from a stock, but you just aren't sure which direction, one thing you could do is use a straddle on that trade, right? So the only note that I'll have on this, though, is that straddles may seem like a great way to play stocks because you're like, hey, if it goes up or down, I can make money. But the reality is that most options are overpriced and favor option sellers. So this strategy is really only to be used situationally, not regularly, right? It requires low implied volatility, which the market hasn't seen on a consistent basis for a while now, right? And even if implied volatility was low for a bit, it's definitely becoming higher and higher now, right? So the definition of a strangle, which is kind of like the cousin of a straddle, so to speak, right? The definition of a strangle is an option strategy where the investor holds a position in both calls and puts, similar to a straddle, but they're both out of the money contracts, right? So it'll be the same expiration, same stock, but out of the money contracts. So again, this is an inherently neutral strategy. You favor heavy movement, right? But let's say coming into the Meta earnings report, it was at 300, rather than buying a 300 call and put like you would in a straddle. Maybe you bought a 320 call and a 280 put, right? And you said, hey, if Meta goes way up or way down, I'll make money, right? In this particular earnings report for Meta, you would have lost on both sides of those options contracts as it currently stands, right? So there are going to be some times, like a couple of quarters ago, Meta had a move to the upside that went thousands of percent. So if you had a strangle on in that trade, you would have made money on that earnings trade, right? But on this earnings trade, you wouldn't have. So all of that to say, while this might seem like a really attractive strategy at first, beware, right? It's kind of like you're a little drunk at the bar and you see somebody, male or female, and you think they look good, and they don't, and it leads you down a road you don't want to go, right? Both genders here, we've all been in that spot, and that's to me what straddles and strangles are, right? Where they had something that looks real good, but it's really not that great of an idea, right? That leads us into the final instrument that we are going to discuss, my friends, which is futures. Futures, unlike that, are actually a very attractive option that you can see at the bar, right? That's something where you're like, oh, buddy, like I would love to take her home, Futures are another instrument in which we can trade. And while they trade as contracts, they are actually significantly different from options, right? Futures trade more like shares than they do like options. So futures traders should note, however, Joel always notes that I put this in, unlike options, you are required to fulfill your contractual obligations in futures. Meaning, if you own a contract of like oil futures and you own it at expiration, and for whatever reason your broker doesn't close it for you, which they will, but if they don't, you will actually be required to take delivery of that asset, which in this case would be like 1,000 barrels of oil, right? So don't hold futures contracts into expiration. Your broker won't let you anyways, right? So what are they? I always first refer to futures as the four horses of the apocalypse, so to speak, right? I don't know where that term comes from. I think it's something religious. I got it from the show Dexter, but there's this four horses of the apocalypse, so to speak, aka the main four futures indexes that we pay attention to on a daily basis. We do watch all of these on a daily basis. The first is the /ES, right? So in Thinkorswim, you type in a / then ES, and that will give you the futures index for the S&P 500, right? So the ETF equivalent of that would be the SPY. The SPY and the ES are the same thing. When I mark my levels, I do the ES futures. I just always have done it that way. I do everything based off of the futures, right? So the next one that there is the /NQ. This is the futures index for the ETF QQQ, right? So those two will track exactly the same, and it is comprised of the NASDAQ 100, right? So big tech names mostly construct the QQQ. There's then the /RTY, which is the IWM, aka the Russell 2000. That's basically small cap stocks, right? So think of like your Plug Powers, your Rivians. Those will generally speaking fit into the Russell 2000 small cap, right? And finally, we have the /YM, which is the DIA, the Dow Jones Industrial Index, which will mostly be industrial names, but it has a mix. It has banks, it has healthcare, it has a little bit of everything. Caterpillar, UNH, a little bit of everything drives that index, right? That being said, there's literally futures for every commodity out there. You name it, there's a futures index for it. Oil, natural gas, corn, soybean, palladium. I don't know if that's a word, but I think it is. Palladium, platinum, copper, eggs. Eggs have a future. Eggs have a future. You could trade eggs and our strategy would work. The liquidity would probably be an issue, but eggs, it's really there. Right? So whatever you can think of or a future for a commodity, there are futures contracts for it. Right? So how do futures move? In reality, futures move very similar to Forex. I'm not sure if any of you are familiar with Forex. I imagine not, but they move very similar to Forex. Rather than buying a call option or buying shares, you are simply long or short on an asset, right? So if you think about this as the ES example, right, which is what most of our students who choose to trade futures, which is about 40 or 50% of my former students, go into the futures realm, which for those of you wondering from a strategic perspective, literally everything is the exact same. So it's just a different asset, right? But most students trade ES, and ES moves in 0.25 increments, which are referred to as ticks. AKA ES would go from 4,200. It would go up one tick to 4,200.25, then 4,200.50, then 4,200.75, then 4,200.1, then 4,200.1.25, and so on and so forth. So for every 0.25 of movement, you don't make 25 cents or 25. That's not the way the math works. It's not like you buy long at 4,200 and that costs you $4,200 and you make $1 up and down. That's not the way that futures work. For every 0.25 of movement, aka a tick, you would profit or loss $12.50 per contract, right? So for every 1 point of ES movement, you would profit or loss $50, right? So let's say in theory, you entered a trade at 4,200, it went to 4,201, and you were long, you would profit $50. If it went from 4,200 to 4,210, you would profit $500, right? There are also what they call micro versions of these futures, which is essentially 1/10 of an ES contract. So there's going to be a ticker in there. It's called /MES, and it stands for the micro version, right? This is a lot more palatable for most of my students to trade on a regular basis because futures can be relatively intense movement sometimes. Micros are much more manageable, and you can trade multiple of them so that you can trim positions, right? So they move the same way, 0.25 movements, but for every 0.25 of movement, you would profit or loss 1.25 per contract, right? So for every 10 points of movement, you would then profit or loss $50, right? So again, let's take a look at this in a specific example. Let's say that ES is trading at 4,200. There's a level there. You see a larger time frame sell setup, so you decide to look for short entries, right? You decide to go short one ES contract at 4,200. Your stop loss is 4,205. Your target is 4,190. So your risk reward there is 2 to 1. You're risking 250 to make 250, right? So for every 1 point of ES that profits or loss $50, right? So if the trade works in your favor, aka if ES moves from 4,200 to 4,190, that has gone 10 points in your favor, thus leaving you with a $500 profit. If ES moves from 4,200 to 4,205, it has moved 5 points in your entry against you, thus leaving you with a $250 loss. So they do not move like $1 for $1. That's not the way that futures work, right? So the next inevitable question that people have is, okay, Jake, well then if I don't have to pay $4,200 to buy one ES contracts, how much do I have to pay? So again, much like Forex, in order to be short or long one contract, it will require a certain amount of buying power or margin, right? So different brokers will require different margin in order to trade futures. So on Thinkorswim or Interactive Brokers or Tastyworks, aka brokers that are also regulated for option and stock trading, they will typically require you to have a pretty significant chunk in your account to trade futures. You would need $16,000. It varies from $14,000 to $16,000 for one contract of ES. That's it's expensive, right? For one MES, you would need $1,600, 1/10 of that, right? There are also brokers out there like Trade-Evate, NinjaTrader that are only futures trading brokers. They have significantly lower margin requirements, right? So to trade one ES contract on Trade-Evate, you would only need $500 of margin compared to that ES $1,600. So in theory, on NinjaTrader or on Trade-Evate, you could have a $500 account and enter this trade up here and double your account in one trade. You could also lose half your account in that same trade, right? So the moral of the story is that on futures only brokers, you can leverage significantly more. And that can be beneficial to you if you have good discipline, right? But it can also be very dangerous for you if you're the type of person who cannot control your position sizing, right? $2,000 of buying power on NinjaTrader would allow you to buy 4 ES contracts. 4. You could be controlling 4 ES contracts for $2,000. On Thinkorswim, that same $2,000 would get you 1 micro, right? So it's dramatically different leverage between the two platforms, right? So for me personally, I would recommend, if you are doing trading futures, to use a Trade-Evate like thing. It's just more realistic in terms of margin requirements, but you really have to be cautious about not over leveraging because it's very easy to over leverage. Very, very easy, right? That being said, let's talk about the pros and cons of futures and options, right? So there are a bunch of pros of futures. One, there's no theta, right? So you don't suffer from time decay. You also have easy defined stop losses and price targets, right? When ES moves up or down a certain amount, you know exactly how much you'll make or exactly how much you'll lose. There's not going to be any question about your profit or loss. It's very exact, which is not always the case with options, not usually the case with options. Futures are also open 23/5. So if you have a lot more flexible trading hours, for me, this is a con. I don't like those more flexible trading hours. And that's the main reason I don't trade futures, is because I need definitive market hours. Otherwise, I would just trade way too often. I know my personality, right? Nice part about futures, though, continuing on with the easy to find price target stop losses, you also have super good liquidity. You can trade $5, $10 million positions in futures. Not that any of you plan to be doing that in the near future, nor do I. But at some point with options, your liquidity levels reach a peak where entering $500,000 into an options position would affect you won't be able to get fills, right? On futures, you can do it in a heartbeat and you'll have absolutely zero issues whatsoever, right? But probably the best part about futures, in my opinion, is that there's no pattern day trader rule. You could have a $2,000 account on Trade-Evate and you could trade over and over and over and over and over and over and over again. That's a good thing, but it's a bad thing. There's also some cons on futures as well, right? There is no IV explosion, meaning that on like Thursday and Friday of trading options, sometimes you'll get those moves where options go like 500%. That's not going to happen in futures, right? You don't have that advantage of implied volatility working in your favor. It's also super easy to go on tilt in futures because you can literally just trade in and out so often that it's very, very easy to go on tilt, especially in Top Step or with a prop firm, with any funding company, right? The one other con of futures is that it limits your relative strength and relative weakness because you're just going to be trading less instruments. Most people who trade futures only trade ES, NQ. That's really it. Some trade RTY, YM, but most don't even do that, right? So it's really going to limit your relative strength and relative weakness options as a trader, right? Which is definitely potential downside depending on the strategy you use, right? Now, a really cool thing that you can do that has become more and more popular over the last year is trading with what's called a funding partner. There are companies out there that you can pay a subscription fee to, and in return for that subscription fee, they will first have you pass a paper trading combine type of thing where you have to prove to them that you're a profitable trader. And then from there, they will actually give you a funded account to trade with, right? So I have personally done this. I used a company called Top Step. I've withdrawn $10,000 total from them. I think so. I think it was $5,000 withdrawals. I think. I don't know. Truth be told, though, you got to be careful with these things because there's a reason they exist and that they work, right? And I'm not bashing them because it's a great business model, right? And it definitely can provide really beneficial stuff to traders with lower capital. But there's a reason that like people buy resets all the time. People go into generative. I personally, the first $5,000 I withdrew from Top Step went directly to paying off my credit cards that I had that I was putting so many charges on for using Top Step, right? For the fees that I paid because I kept doing the resets over and over and over again, right? So it's a really, really, really great potential outlet for you all. If you have more questions about trading with a futures account, I highly recommend that you take some time to reach out to JBab or reach out to Ron G or Ali, because they are people who do this like on a regular basis with, and I think JBab in particular, who's on tonight, I know he trades, he literally has like multiple funded accounts that he's withdrawn from. So if you have questions about this specifically, I would definitely encourage you to reach out to him, talk to him more about it. Use his affiliate link, maybe potentially like set up a one-on-one because it really is a good outlet. We've seen students take crazy withdrawals from these platforms, right? Like tens of thousands of dollars. So it is possible. It's just, I've also seen students go tens of thousands of dollars in debt paying the fees. So you want to make sure you have a really good structured plan in order to pass one of these funding challenges, right? So that being said, my friends, that is all I have for you on futures. I don't trade them on a daily basis anymore, but for a long, long time that I did. Now, I know our last two lessons have been the slowest paced lessons that we've had yet, right? Again, it's not that this is like intentional, but it kind of is. We really specifically go through 3 previous lessons that are all 2 hours long and a whole lot of thick material, right? So a lot of information to process. So these next 2, we take a step back, kind of go at a slower pace, but we cover material that we need to. Like I wouldn't feel good as an educator leading a mentorship program if I didn't cover this material with you all, because I feel like I would be leaving you hanging and for you to potentially losing large sums of money due to inadequate knowledge on these subjects of the instruments that you're trading, right? That being said, like I mentioned, I know that people want more and more of the technicals from me. I encourage you, let's get that Mastermind 10 bonus lesson completion section pumped up a little bit. All right. The numbers aren't all that high yet. So if you want more technicals, you better make sure that you have gone through all of those first. It's very carefully designed, right? Now, in our next lesson tomorrow night, I am extremely, extremely excited. We're going to be wrapping up everything that we've talked about so far, right? So we are going to be talking about how we integrate lesson 1 into lesson 2, into lesson 3, 4, and 5, into lesson 6 and 7, and how we use all of those things each day to finalize and streamline the process that we have for finding stocks to trade each day, along with our concrete strategy that we use on a daily basis, right? So with that being said, my friends, that is all I have for you in tonight's lesson. This has been a great one. Big shout out to, I swear, if I messed it up and it's not JBab and Mullet on, I'm going to kick myself, but I think it's both them. Seriously, big shout out to having you guys on for helping answer questions. Thank you all so much for being here. For those of you who stuck with me this entire time. And I cannot wait to see you for our final, not fully final, because we are definitely going to be doing a bonus lesson in the couple of weeks after Mastermind 10.0 is finished. But our final official lesson 8 is tomorrow night. I cannot wait. I will see you all as soon as we get there. All right. Cheers, gang, 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 gang.